fixed asset turnover ratio, that's what we are going to understand through this example. You have following information, basically the sales information and fixed assets information from the year 2021 up to 2024. And if you notice, in the year 2021, when their sales was 50, let's say figures are in crores, when the sales is 50 crore, their investment in fixed assets is 40 crore, and the sales increased. They've also made a big jump in investments from 40 to 150 crore in the year 2022, and that got maintained, more or less maintained, and there is also corresponding increase in sales. And now we have to analyze. To analyze that, let's make use of fixed asset turnover ratio. That is, we will be comparing the sales with fixed assets. Let's do that for year 2021. That is 50 divided by 40. The ratio is 1.25. We can express that as 1.25 is to 1. It means in this year, that is in 2021, for every 1 rupee investments they had in fixed assets, they were able to make a sale of 1 rupee 25 paise. It means they are rotating their fixed assets 1.25 times to achieve the sales, which shows they are making best use of the available assets. Whereas in the year 2022, they made a significant investment, almost additional 90 crore, and that result may not be able to seen in the same year itself. Okay, so even though we calculate, it may not communicate the real position, but let's do it. 80 is the sales, which is the numerator, and 150 is the fixed asset, which is denominator. So 80 by 150, you get the ratio as 0.533 is to 1. It means for every 1 rupee invested in fixed assets, they are able to make sales of only 53 paise, and this is okay, acceptable in this year, because in that year only investments have taken place. So these investments will start contributing to additional sales only in the future period. Fine. Then what is happening in 2023? Their sales have increased from 80 to 100 crore. Fixed assets maintained almost at 150 crore. Okay. So 100 by 150, the ratio is going to be 0.67 is to 1. So this is the year immediately after the year of investment. And here they may not have achieved their optimum sales level also. So this year also, okay, to a certain extent acceptable. For every 1 rupee of fixed assets, they are able to make only 67 paise. See, we have to understand one thing. Here, if the fixed asset has to do justice, it should help in achieving a sales equivalent to the investment made in fixed assets, because only that sales will generate the cash, only that sales will generate the profit, and the people who have invested in fixed assets are going to look at return on investments by taking the investment made in the fixed assets as a base. So if the sales is not equal to this, or if the sales is not going to be greater than this, then whatever the sales profits or whatever the sales that is going to help in generating profit may not be adequate enough to meet the return on investment expectations. Okay, that's why I said this is good, because here investment is only 1 rupee and people are going to expect return on investment on this 1 rupee only, and this 1 rupee 25 paise is going to generate profit, and that profit may match the return on investment expectation. But here the scenario is different. They are looking for return on investment on 1 rupee, and for that they are sending sales of only 67 paise. So whatever the profit it is going to generate, it may not meet the expectation. That's why this is seen as good and this is seen as poor. And let's see what is happening in 2024. 130 and 150. 130 in the numerator, 150 in the denominator, still the ratio is 0.87 is to 1. So people are looking for a return on investment on this 1 rupee, but for that they are sending out only 87 paise to generate profit. So it may be generating profit, but it may not match the expectation. So if a business has to have a comfortable fixed asset turnover ratio, means it should be making greater than 1. And this is very important, especially in capital intensive business where the sales, profit generation, everything is linked with the assets that have been created. So they have to strive for achieving a fixed asset turnover ratio greater than 1. Here the situation is improving year after year. Maybe in 2025 it might touch 1, but if it is not touching 1 and if it is going to remain below, then this organization may not be able to fulfill the expectation of the investors in this fixed asset.